The biggest mining merger in history just collapsed. A deal that would have created a commodity superpower worth over $400 billion, gone. Rio Tinto and Glencore, two of the world's most powerful mining giants, were this close to reshaping the entire global resources landscape. But something happened. Something that reveals the hidden tensions, the strategic miscalculations, and the shocking power dynamics that govern the Australian mining sector. What really went wrong? And what does this seismic failure mean for the future of mining in Australia and around the world? Let's rewind to where this monumental deal began. In late 2024, whispers started circulating through the mining world. Whispers that Glencore, the Swiss-based commodity trading and mining behemoth, had approached Rio Tinto with a merger proposal. Not just any merger, this was the merger. The kind of consolidation that happens once in a generation, if that. Industry analysts were stunned when news broke that preliminary discussions had taken place. We're talking about combining Rio Tinto's market capitalization of roughly $120 billion with Glencore's $75 billion valuation. The numbers were astronomical. But here's what made this deal so explosive. Rio Tinto is the crown jewel of Australian mining. With operations spanning the Pilbara iron ore fields in Western Australia, massive copper deposits, lithium projects, and aluminum smelting capacity, Rio Tinto represents the pinnacle of integrated mining excellence. The company produces over 300 million tons of iron ore annually from its Australian operations alone. That's iron ore that feeds the steel mills of China, Japan, and Korea, the backbone of global infrastructure. Glencore? Glencore operates differently. While Rio Tinto focuses on large-scale, long-life mining assets, Glencore built its empire on commodity trading and mining. They're the middlemen, the deal-makers, the traders who move commodities around the world. Their mining portfolio includes coal operations in Australia's Hunter Valley and Bowen Basin, copper mines across multiple continents, and zinc production facilities. But their real strength? The trading arm that generates billions in revenue by buying, selling, and moving commodities through global markets. So, when these two titans started merger talks, the mining world paid attention. Imagine it, Rio Tinto's operational excellence combined with Glencore's trading prowess and diversified commodity base. A merged entity would have controlled roughly 10% of global copper production, dominated Australian iron ore exports, held significant positions in coal, zinc, nickel, and cobalt. The strategic logic seemed undeniable. Industry executives started doing the math. The combined company would have generated revenues exceeding $80 billion annually, operating across 6 continents, employing over 150,000 workers, with mining operations in Australia, Africa, South America, Asia, and North America. The potential synergies were staggering. Analysts estimated cost savings of up to $3 billion through operational efficiencies, shared infrastructure, streamlined corporate structures, and optimized supply chains. For Australia specifically, this merger carried enormous implications. Rio Tinto is deeply embedded in the Australian economy. The company pays billions in royalties to state governments, provides tens of thousands of direct jobs, and supports entire regional communities in Western Australia, Queensland, and the Northern Territory. Glencore's Australian coal operations contribute significantly to Queensland's economy and export revenue. Together, their combined Australian operations would have represented a mining powerhouse without parallel. But then, reality struck. And this is where things get really interesting, because beneath the surface-level strategic logic, there were fundamental problems so severe they would ultimately torpedo the entire deal. Problem number 1, corporate culture clash. Rio Tinto operates with a premium mining philosophy. They pursue Tier 1 assets, massive, long-life deposits with low costs and high margins. Their Pilbara iron ore operations exemplify this approach. Autonomous haul trucks, centralized operation centers managing mine sites remotely, world-class infrastructure, including private rail networks and port facilities. Rio Tinto's return on invested capital consistently outperforms industry averages. They're disciplined, focused, methodical. Glencore? Glencore's DNA is fundamentally different. They're traders first, miners second. Glencore executives thrive on volatility, on market opportunities, on complex deals and financial engineering. Their business model embraces commodity price swings. When prices spike, their trading division profits from moving material through global supply chains. When prices crash, they short markets or shift strategies. It's aggressive, opportunistic, fast-moving. These philosophical differences might seem minor, but they're everything in mining. Rio Tinto makes 15 to 20-year investment decisions based on geological confidence and operational excellence. Glencore capitalizes on 18-month trading windows and market inefficiencies. One company thinks in decades, the other in quarters. How do you reconcile that? Problem number 2, regulatory nightmares. And this is where the deal really started falling apart. Because when you combine two companies this size, regulators in every major market start asking tough questions. The Australian Competition and Consumer Commission would have scrutinized this merger intensely. Combined market share in Australian coal? Potentially anti-competitive. Iron ore dominance? Rio Tinto already controls massive Pilbara production. Adding Glencore's trading tentacles could raise vertical integration concerns. But Australia was just the beginning. European Union competition authorities, they would have launched comprehensive investigations. China's Ministry of Commerce, as the world's largest commodity importer, Chinese regulators would have had major concerns about a combined Rio Glencore controlling critical mineral supply chains. The United States Federal Trade Commission, they'd want assurances about copper supplies and strategic mineral security. The regulatory approval process could have stretched 18 to 24 months, maybe longer, with no guarantee of success. Companies would have faced potential divestiture requirements, being forced to sell valuable assets just to win regulatory approval. What's the point of a mega merger if you have to immediately break up parts of the combined business? Problem number 3, and this one's absolutely critical, shareholder alignment. Rio Tinto's shareholder base includes major institutional investors, Australian superannuation funds, and index trackers who value steady dividends and capital discipline. Rio Tinto returned over $8 billion to shareholders in 2023 through dividends and buybacks. Shareholders expect this. Glencore shareholders? Different beast entirely. Many Glencore investors specifically want exposure to commodity trading volatility. They're comfortable with variable returns, with trading risks, with the boom-bust commodity cycle. A merged entity would have to satisfy both shareholder bases, conservative dividend seekers and volatility-embracing traders. How do you design a capital allocation strategy that makes everyone happy? You don't. But wait, there's more. Problem number 4 reveals itself when examining the deal structure itself. Merger of equals? Acquisition? All-stock transaction? Cash and stock combination? Each structure creates winners and losers. Rio Tinto shareholders weren't going to accept dilution without premium compensation. Glencore shareholders wanted participation in the combined entity's upside. Negotiating exchange ratios that fairly valued both companies while accounting for synergies, risks, and future commodity price assumptions nearly impossible. Senior banking sources familiar with the discussions, speaking on condition of anonymity, indicated that valuation disagreements became increasingly contentious as negotiations progressed. Rio Tinto executives believed their premium assets justified a higher relative valuation. Glencore countered that their trading expertise and diversified commodity exposure added value that pure miners couldn't replicate. And then there's the elephant in the room that nobody wanted to discuss publicly: governance. Who runs this combined behemoth? Rio Tinto's board? Glencore's leadership? A completely new executive team? The CEO question alone could derail negotiations. You can't have two captains steering the ship. Geographic considerations added another layer of complexity. Rio Tinto maintains dual-listed company structure with headquarters in London and significant Australian operations managed from Melbourne and Perth. Glencore operates from Switzerland. Where does the merged entity base its headquarters? London? Zurich? Melbourne? Each choice carries tax implications, regulatory consequences, and symbolic significance. But perhaps the most underestimated challenge: integration execution risk. Merging two massive, complex, globally distributed mining and trading operations while maintaining production, preserving safety standards, retaining key talent, and capturing synergies? The track record of mega mergers in the resources sector is mixed at best. Consider the operational complexity. Rio Tinto runs highly automated iron ore operations in the Pilbara using integrated planning systems, autonomous technology, and centralized remote operations. Glencore manages diverse mining operations across coal, copper, zinc, and nickel, with different operational approaches, varying technology standards, and decentralized decision-making. Harmonizing these systems, integrating supply chains, aligning safety protocols and environmental standards across dozens of mine sites, the complexity is staggering. And we haven't even touched on environmental, social, and governance considerations. Rio Tinto faced massive reputational damage from the Juukan Gorge incident in 2020, where they destroyed Aboriginal heritage sites in Western Australia. The company has spent years rebuilding trust with traditional owners, improving cultural heritage management, and reforming governance. Glencore has faced its own ESG challenges, including corruption allegations in Africa, environmental compliance issues, and questions about coal exposure in a decarbonizing world. A combined entity would inherit all these legacy issues: compliance obligations, stakeholder relationships, and reputational challenges. How do you merge two companies with different ESG profiles, different stakeholder commitments, and different strategic approaches to decarbonization? The social license to operate, increasingly critical in modern mining, becomes exponentially more complex. Let's talk about the commodity portfolio integration challenge. Rio Tinto is heavily weighted toward iron ore and aluminum, with growing exposure to copper and battery minerals. Glencore's portfolio includes significant thermal coal operations, exactly the assets many institutional investors want out of their portfolios. Environmental, social, and governance-focused investors were already questioning whether they could own the combined entity. Some ESG investment funds have explicit exclusions on thermal coal exposure above certain thresholds. A Rio-Glencore merger could have triggered automatic divestment from major institutional holders. Imagine announcing the biggest mining merger in history, only to watch billions of dollars of institutional capital flee because ESG mandates prohibit ownership. The optics would be devastating. Now here's where the story takes a dramatic turn, because industry observers started noticing concerning signals. First, the initial optimism following the merger announcement began cooling. Media coverage shifted from excitement about strategic synergies to skepticism about execution risks. Financial analysts who initially praised the deal started publishing more cautious research notes. Then came the shareholder reactions. Several major Rio Tinto institutional investors expressed concerns publicly, highly unusual for typically discreet institutional money managers. They questioned the strategic rationale, worried about integration risks, and demanded clarity on value creation. One prominent Australian superannuation fund manager stated publicly that they needed convincing evidence the merger would enhance long-term returns. Behind the scenes, proxy advisory firms, the influential organizations that guide institutional voting decisions, were preparing negative recommendations. ISS and Glass Lewis, the two dominant proxy advisors, were reportedly skeptical about the deal structure and concerned about governance implications. Their recommendations carry enormous weight with institutional shareholders. Regulatory feedback was equally concerning. Early informal consultations with competition authorities in Australia, Europe, and China revealed significant hurdles ahead. Regulators weren't outright rejecting the concept, but they were identifying dozens of potential competition issues that would require detailed investigation and likely divestitures. The Australian Competition and Consumer Commission indicated particular concern about coal market concentration in Queensland and New South Wales. European Union officials flagged potential vertical integration issues where Glencore's trading division could disadvantage competitors. Chinese regulators wanted assurances about supply security and pricing transparency. Internal dissension emerged too. Reports surfaced of disagreements within Rio Tinto's leadership team about the merger's strategic merit. Some executives strongly supported the combination, seeing transformative potential in creating a truly diversified mining major. Others worried that integrating Glencore would distract from Rio Tinto's core strengths and dilute their premium market positioning. The boardrooms on both sides experienced tensions. Independent directors questioned deal assumptions, challenged synergy estimates, and demanded more rigorous analysis of integration risks. The deeper both companies looked, the more complicated everything became. And then, the commodity markets threw a curveball. Iron ore prices, which had been relatively strong, started experiencing volatility driven by Chinese real estate sector uncertainties. Copper prices fluctuated on concerns about global economic growth. Coal markets faced pressure from renewable energy deployment and decarbonization commitments. Suddenly, the commodity price assumptions underlying deal valuations looked questionable. Market volatility made valuation negotiations even harder. What's a fair exchange ratio when commodity prices are bouncing around? How do you value a trading division when market conditions are uncertain? Both companies' share prices moved independently based on commodity-specific dynamics, making merger math increasingly complex. By early 2025, insiders recognized the deal was in serious trouble. Negotiating teams had spent months working through issues only to encounter new obstacles at every turn. What started as an exciting strategic vision had devolved into exhausting technical negotiations with no clear path to resolution. Both companies faced a critical decision: continue pursuing a deal with massive execution risks, significant regulatory uncertainty, shareholder skepticism, and questionable value creation? Or walk away, preserve their independent strategic flexibility, and avoid a potentially disastrous integration? The decision came swiftly. In a brief joint statement, Rio Tinto and Glencore announced termination of merger discussions. The language was diplomatic, professional, courteous. Both companies thanked their teams for their efforts, expressed mutual respect, and indicated they would continue focusing on their independent strategies. But behind the corporate speak, relief. Senior executives on both sides privately acknowledged that the merger had become too complicated, too risky, too uncertain. Better to walk away with reputations intact than force through a deal that might destroy shareholder value. Market reaction was fascinating. Rio Tinto's share price actually rose on news of the deal's collapse. Investors celebrated the company's decision to maintain strategic independence and avoid integration risks. Analysts upgraded Rio Tinto ratings, praising management for discipline and focus on core strengths. Glencore's stock response was more muted but still positive. Investors appreciated avoiding the regulatory nightmare and corporate culture clash. Glencore's unique business model, combining trading and mining, remains differentiated in the industry. Why dilute that distinctiveness through merger? So what does this spectacular failure teach us about the mining industry? Several critical lessons emerge. First, bigger isn't always better. The mining industry has seen numerous mega mergers over the past decades, with mixed results at best. BHP and Billiton merged in 2001, creating value over time but facing ongoing dual-listed complexity. Glencore and Xstrata combined in 2013, requiring years to integrate fully. Scale advantages in mining aren't unlimited. Beyond a certain size, coordination costs, bureaucratic complexity, and organizational inertia can outweigh economies of scale. Rio Tinto and Glencore were already enormous companies with strong competitive positions. Adding more scale wouldn't necessarily create proportional value. Second lesson, corporate culture matters enormously. You can't just smash together two companies with fundamentally different business philosophies and expect seamless integration. Rio Tinto's operational discipline and long-term asset focus versus Glencore's trading agility and market opportunism, these aren't complementary, they're contradictory. Third, regulatory scrutiny of mega mining mergers is intensifying. Governments worldwide are increasingly concerned about commodity market concentration, especially for strategic minerals. The days of waving through massive mining consolidations with minimal conditions are over. Expect tougher regulatory reviews, longer approval timelines, and more stringent divestiture requirements. Fourth lesson, and this one's crucial for Australian mining, maintaining strong, independent operators might better serve national interests than creating mega corporations. Australia benefits from having multiple competitive mining companies paying royalties, employing workers, investing in technology, and competing for talent. Consolidation could reduce competition and innovation. What's next for both companies? Rio Tinto is doubling down on its core strategy, maximizing Pilbara iron ore production while investing heavily in copper expansion and battery minerals. The company recently announced major capital commitments to brownfield iron ore expansions and greenfield lithium projects. Their focus remains clear: own and operate Tier 1 assets in stable jurisdictions. Glencore continues leveraging its unique integrated model. Their trading division remains highly profitable, generating consistent returns through market cycles. On the mining side, they're managing thermal coal exposure carefully while growing copper and zinc production. Glencore's strategy embraces their hybrid trader-miner identity rather than trying to transform into a pure mining company. For Australian mining specifically, this failed merger has several implications. First, it confirms that Australian mining assets remain highly valued globally. Rio Tinto's Pilbara iron ore operations were a key attraction in this deal. Their productivity, cost position, and expansion optionality make them world-class. Second, it demonstrates that Australian mining companies can resist merger pressure and maintain independence. Not every combination makes strategic sense, even if bankers and advisors promote synergy narratives. Sometimes, staying independent and focused delivers better shareholder returns. Third, the failure highlights ongoing challenges in mining M&A. Commodity price volatility makes valuation difficult. Cultural integration is genuinely hard. Regulatory approval isn't guaranteed. Shareholder skepticism can kill deals. These aren't abstract concerns. They're real barriers that derailed the biggest mining merger attempt in history. Looking forward, what might this mean for future mining consolidation? Expect more targeted strategic acquisitions rather than transformational mega mergers. Companies will focus on adding specific assets that complement existing portfolios rather than attempting complete business model transformations. Battery minerals will drive M&A activity. Lithium, nickel, cobalt, and graphite producers face acquisition interest from major mining companies seeking energy transition exposure. These deals are smaller, more focused, and easier to integrate than multi-billion-dollar mergers of mining giants. Joint ventures might replace outright mergers. Companies can achieve some collaboration benefits, shared infrastructure, combined marketing, technical cooperation, without full integration complexity. The mining industry has long used joint ventures successfully for large capital projects. What about Glencore's trading division? Could that be spun off independently? Some analysts have suggested that Glencore's trading and mining businesses might be worth more separated than combined. Specialist commodity traders face different market dynamics than industrial miners. A split could unlock value by allowing each business to pursue its optimal strategy. The broader commodity markets continue evolving. China's economic trajectory remains the single biggest variable for Australian mining. Chinese steel demand drives iron ore prices. Chinese infrastructure spending influences copper consumption. Chinese manufacturing shapes industrial metals markets. Any slowdown in Chinese growth immediately impacts Australian mining profitability. Energy transition dynamics are reshaping mining fundamentals. Copper demand for renewable energy infrastructure and electric vehicles is structural and growing. Lithium requirements for battery production are exploding. Nickel for battery cathodes is increasingly critical. Traditional thermal coal faces long-term decline despite short-term price volatility. Australian mining companies are repositioning portfolios accordingly. BHP is exiting thermal coal, expanding copper, and entering potash. Rio Tinto is growing battery minerals exposure while defending iron ore dominance. Fortescue Metals is diversifying into green energy and battery materials. The sector is adapting to emerging commodity demand patterns. So why did the biggest mining deal in history fail? Not because of a single fatal flaw, but because of accumulated complexity. Cultural incompatibility, regulatory obstacles, shareholder skepticism, valuation disagreements, integration risks, commodity volatility, ESG concerns, governance challenges. Each issue alone might have been manageable, but together they created insurmountable barriers. The lesson for mining investors? Strategic logic on paper doesn't automatically translate to value creation in reality. Mega mergers sound exciting, generate media attention, and energize investment banking teams, but executing them successfully requires navigating extraordinary complexity while maintaining operational performance, shareholder support, and regulatory approval. Rio Tinto and Glencore made the disciplined decision to walk away rather than force through a deal with questionable prospects. That discipline deserves recognition. Too many companies pursue transactions for strategic pride or competitive positioning, only to destroy value through poor integration. Both companies now face the market independently, focusing on their respective strategies. Rio Tinto continues perfecting operational excellence in large-scale mining. Glencore leverages its unique trading expertise alongside mining operations. Each company can move faster, adapt more quickly, and execute their distinct strategies without compromise. For Australian mining more broadly, the sector remains vibrant, competitive, and globally significant. Multiple strong independent operators competing for resources, talent, and market share drives innovation and efficiency. The failed Rio-Glencore merger might actually benefit Australia by maintaining this competitive dynamic. The mining industry will continue consolidating, but through strategic, targeted transactions rather than mega mergers. Companies will acquire specific assets, form joint ventures on major projects, and pursue bolt-on acquisitions that strengthen core positions. The days of transformational megadeals creating instant commodity superpowers might be ending. And perhaps that's healthier for the industry. Maintaining diverse strategies, competitive dynamics, and independent decision-making might generate better long-term outcomes than consolidating into a few massive conglomerates. The mining industry has always been cyclical, volatile, and capital-intensive. Diversity and competition help it adapt. So the biggest mining deal in history failed, but that failure reveals important truths about modern mining. Scale isn't everything. Culture matters. Regulatory scrutiny is real. Shareholders demand clear value creation. Integration is genuinely difficult, and sometimes the best deals are the ones you don't do. Rio Tinto and Glencore will continue shaping global commodity markets independently. Australian mining will remain strong with multiple competitive operators, and the industry learned valuable lessons about the limits of mega-merger ambitions. The deal failed, but the companies and their shareholders might be better off because of it.